So the bond market works just like every other market in terms of supply and demand. So who are the suppliers of bonds? Well, obviously it's anybody that's selling. It's anybody that owns bonds and can sell. So I believe we've seen a lot of foreign governments, including China, actually be net sellers of bonds recently. So that's supply. But at the end of the day, the largest amount of supply that comes into the bond market is from the Treasury itself. Right? Why does the Treasury issue bonds? They do it to raise debt in order to fund the government operations. And obviously, one of the big topics of discussion recently, but it's honestly also been a topic of discussion my entire career and probably my entire life, has just been the amount of debt that the Treasury actually has overall, and especially the recent conversation has been around with rising interest rates. It becomes more expensive to service that debt. So that's becoming a problem. But I don't, no point in getting into all that. But basically, supply and demand. So the Treasury needs to sell a certain amount of bonds each, period, each month, in order to be able to fund the government. That selling is supply. So more supply and equal demand means that your stock, or in this case, your bond price, goes down. And the interesting thing is, so who's there to actually soak up that supply? Who's coming in and buying it? Well, it's foreign governments, it's pension funds, it's hedge funds, it's regular people that want to own what has always been considered to be a risk-free asset and get risk-free return. For a long time, up until somewhat recently, it's been one of the biggest buyers has been the Fed, right? That's what QE is. QE is the Fed actually coming in and acting as a buyer of treasuries. So right now we're in an environment where the U.S. government is having to issue even greater supply of treasuries because the debt has gotten so out of control, our spending needs are so out of control, and we've got less buyers out there. Because instead of China, which has been a very big buyer of treasuries for a long time, being a buyer, they've actually been a seller for several months now. I don't know if that's changed in October, but we've seen the data that like all summer for sure, China has been a very big seller of U.S. debt, and they hold a massive amount of U.S. debt. So they're not coming in and buying right now. If anything, they're potentially adding to supply, or at least that's what they've been doing. The Fed's not coming in and buying right now. So who's coming in and buying? There's definitely people coming in and buying who want exposure to be able to lock in these higher rates. For years and years and years, you'd be buying bonds and getting a negative real return, and now you can get a really nice return and a positive real return on treasuries. So there's people honestly like you and me who are taking long trades in TLT because interest rates have gotten so high. So that's where some demand is coming in. But again, it's a supply and demand story. And what does this note say? What happened at 8:30? Well, the estimate was that the Treasury was going to refund by 114 billion, so 114 billion worth of supply. But they decided they're only going to refund by 9 to 112 billion. So that means that's significantly less supply that's actually going to come onto the market versus expectations. So what happens then? Less supply, equal demand. The TLT, or the bonds in this case, can move higher, which means that interest rates go down. And Dimitri summed it up here in a perfect little equation for you. Less supply of long-term bond issuance equals lower rates, which is bullish on the long end of the curve and bullish for risk assets. What are risk assets? Well, risk assets include equities, includes U.S. equities. So that was also bullish in addition to the Fed today. So we had a lot of ammo this morning that is potentially bullish for equities, and obviously equities followed through with that, though the average stock did not necessarily, because there's still reasons to be fearful. Even if the Fed is pausing, you still might have higher for longer. Unlike what we've spoken about recently, a lot of these companies are going to have to re-raise debt in 2024, but more like 2025 and 2026. They're small caps and mid caps, and if interest rates are still very high at that time, it could be so painful that it could lead to the demise of some of these unprofitable small caps, mid caps, startup companies, things like that. But I also think that some of these names, a lot of these names, are trading very cheap as a result. So, and that's always the argument when you're talking about stocks that are cheap versus stocks that are expensive. And we've spoken about this in a lot of afternoon meetings recently as well. Like if you look at, I think a lot of these IWM names right now, from a fundamental perspective, and this is why fundamentals, in my opinion, are not enough to be like a successful trader, investor, anything. You really need to learn to understand and read charts, because charts tell you truly supply and demand, and that can be more important, because stocks can be cheap for a reason, or stocks can be expensive for a reason. And we've discussed here that maybe some of these IWM names are cheap, but they're cheap for a reason, and that's because when their debt rolls off, they're going to have to raise new debt, and they're not profitable at significantly higher rates that can negatively impact potentially even those companies as going concern. Versus if you look at Microsoft, we've discussed, Microsoft's got a high multiple. It's still at these prices, I believe, higher than its recent historical average. By recent, I don't know, go back 5 years. But maybe it's justified in doing so because of the amount of cash that they have on hand versus the amount of debt that they have, and the fact that debt is locked in at 3%, and it's longer term debt than what your average small cap and mid cap is actually dealing with. So, I want to see some of these cheaper stocks wake up. I want to see this IWM wake up and work its way back up towards that 21 EMA, in conjunction with a little bit of a relief coming from the bullishness of the Treasury at 8:30 and the Fed today at 2 o'clock, if you want to call it that.